Folks, we have breaking news from the stock market. Jerome Powell has practically confirmed that the Fed will cut rates in September. While he didn't spell it out, he hinted enough for the market to understand what's coming. So, if you're an investor, the question is your portfolio ready for this shift? A rate cut can change the game, impacting stocks, bonds, and everything in between. Now's the time to assess your portfolio, not just for small caps, but for other asset classes that stand to benefit from this new environment. Today, we'll dig into the specifics. First, I want to thank the subscribers who've joined this channel in the past month. Your support has been incredible, and I'm genuinely humbled. Now, for those asking about spots in the Academy, currently, we're full, but we may open a few slots in the coming months, so stay tuned. Meanwhile, join the free Discord community. It's packed with 15,000 people sharing valuable insights. Now, let's get into it. The next Fed meeting is in September, and the CME tool is pricing a 100% chance of a rate cut. Some experts even predict multiple cuts this year, but it's not the number of cuts that matters, it's the start of a downward trend. Once the Fed begins cutting rates, we're likely looking at a continuous drop, eventually bringing rates down to 4% or even lower. This shift will inevitably impact the markets, and certain sectors will stand to gain significantly. So, which sectors should you focus on? The industrial sector, real estate, financials, and small caps have all been hit hard by rising rates, but with cuts on the horizon, they're likely to rebound. If you're considering ETFs, you might look at IWM for small caps, XLF for financials, and XLI for industrials, as well as various REITs for real estate exposure. Do your research and see what fits your strategy. The Russell 2000, which includes 2,000 smaller companies not in the S&P 500, has been lagging for about 18 months. These companies carry more debt, which makes them vulnerable to rate hikes, but primed for gains as rates fall. Many of these companies have floating rate debt, meaning they're extremely sensitive to rate changes, and lower rates should help their valuations bounce back. Additionally, valuations of small caps often rely on future earnings, and lower rates boost the present value of those future earnings. This is where small caps could shine, and analysts predict a strong potential for growth here. Tom Lee believes the Russell 2000 has a lot of upside potential, suggesting it could rise by as much as 40% by year's end. Historical data backs this up, showing an average 27% gain in small caps in the year following a Fed rate cut. The Russell 2000 is still below its 2021 peak, so there's substantial room for growth. Now, does this mean you should ditch big caps? Absolutely not. Big tech and large cap stocks will remain dominant over the long term, and they'll also benefit from rate cuts. What we're suggesting is a bit of a rebalancing, adding some exposure to small caps without overhauling your entire portfolio. This could be a 6-month strategy to capture some of the gains expected in these lagging sectors. If you're a long-term investor, this is an opportunity to diversify slightly and add some excitement to your portfolio. But don't go all in, use it as a tactical adjustment rather than a full shift. Thank you for tuning in. I'm currently in Thailand, enjoying a well-earned vacation, but I had to bring you this update. I'll be back soon with more insights. See you in the next video.